joining us. We'll have to take the story forward with three very special guests, Maithili Bisnurmat, Saugata Bhattacharya, and of course Ashwin Parekh. Thanks each one of you for being with us. Maithili, you've seen the big picture they've tried to highlight. Greece and Fed continue to be a big pain points, but the asset quality concerns, and like Gopika was pointing out there, the FSDC has really delved deep into it and talking about that. Your first take on the RBI, the FSDC report, is this perhaps more negative than warranted, or are they just being as realistic as possible?
Well, I'm not really talking about. In fact, I would think the Fed is far more important a factor than Greece. As far as the asset quality is concerned, the numbers are not very much worse than what they were in the previous financial stability report. Roughly, 10.7% was what they said for the stressed assets, and public sector banks again was 12.9, now 13%. So I would in fact think that things are, in fact, the very fact that they've not really worsened, despite the tightening or whatever norms you had, especially in terms of prudential norms, in terms of withdrawal of forbearance from the 1st of April, I would think that things are broadly, I wouldn't say well in satisfactory shape, but the very fact that they haven't worsened suggests that the economy is improving and banks' position is in fact on the mend. Very slowly perhaps, but the fact that they haven't deteriorated despite very many other factors is, I think, a reason, if not for cheer, but for cautious optimism.
All right, cautious optimism is the word coming in because the asset quality hasn't worsened, even if it hasn't improved. Ashwin Parekh, are you as optimistic as Maithili here on the show is?
Well, yes. I mean, to the extent that the economy seems to be looking up now, there are several indicators which do suggest that at least after the first 2 quarters, 1 or 2 quarters, we may find some bit of sort of green shoots and some bit of capital expenditure coming in and some amount of easing off of recovery from the banking system. So, I mean, I would certainly say that caution is the word, but there is no need to be panicky or over cautioned about the whole thing.
All right, no need to be panicky and no need to be overcautious. I'm wondering if you're referring to the very negative narrative that came in from RBI and its monetary policy, and I'm going to come and pick your brains on that in just a minute from now. But Saugata, very quickly, the Greek crisis, the Fed rate hike could trigger global financial market volatility, and interestingly, this is coming just a day after Raghuram Rajan actually said that Greece will have little impact on Indian economy. Which of the two versions should one believe in? Is Greece a known event of sorts as far as India is concerned, or could it actually spoil the picture back home?
I mean, it definitely will. We've just heard that the talks have closed without any conclusive decision. So, I mean, without a doubt, I mean, there will be transient volatility, particularly if the decision is taken for steps towards moving towards a Greek exit. But it's not, I don't think it's likely to persist over a period of time. I think the bigger worry, as Maithili said, is the impact of a Fed rate hike, which might be as soon as September. So I think, but both of these will be relatively contained, I believe, I mean, in different orders of magnitude. But I think the bigger focus now is what happens in India.
Maithili, are the layers of defense in place as far as a potential Fed rate hike is concerned? You speak to a lot of people here in finance ministry and they give you a sense that they do expect volatility to happen in December or January. That's when they're expecting Janet Yellen to act on rates. But are there enough layers of defense?
Well, one can never be entirely prepared for something like a Fed rate hike, because purely for the reason that the Fed hike would come after close to 8 years. So given that, I think it would be quite a traumatic event for the world at large, and given that the Indian financial markets, particularly the forex markets, are fairly thin, there would be repercussions. But to the extent, once again, that we have far better reserves than we had in September 2013, when there first was talk of July, August, September, those months of 2013, I think we're far better prepared. Also to the extent that we're not the worst amongst the emerging markets. In fact, I wouldn't quite agree with Mr. Jaitley entirely when we say we're the bright spot in the troubled world. But we're certainly not a bad spot at all to be in. We're in a pretty good place in looking at the world economy, global economy. So I think the repercussions as far as India is concerned would be far less than what they were in 2013, much less than what perhaps would happen in the case of other emerging markets. So one can never be fully prepared, but we are far better prepared than we were about 2 years ago.
Ashwin Parekh, you have a view on the repercussions as far as the Fed rate hike is concerned. I agree with Maitri, we can never be fully prepared and there is going to be some amount of knee-jerk reaction, but the pain has considerably reduced since the first time he murmured taper way back in 2013. Are we, and I'm going to repeat that question, are we better prepared? Are we not going to see the reactions that the FSDC is indeed talking about, which is the global financial market volatility will pervade India?
No, I mean with the last 2 quarters, 3 quarters of progress, I think, I mean the shock may not be as much as severe as we could have had it, 2 years ago or a year ago. But that's one observation. The second observation is somewhere along, I mean I'm getting an impression that the governor is in some form, or the RBI is in some form preparing for continued hard interest rate kind of a regime, not softening up too much. I mean, because all these cautions which are, whether it is, the performance of corporates and their ability to repay, or whether it is the external factors such as Greece and such as Fed rate, these are, I suppose, some form of fears which have been talked about. I mean, is it really leading to once again a continued hard interest rate kind of a stance, or is it something else, is something which, I mean, I thought I'll just quickly look at.
Fair point indeed, but let's get down to the basics and let's talk about the bank's balance sheets, because like Gopika was pointing out there, the FSDC has really delved deep into this time around. Shagada, I'm going to throw this to you. The gross NPAs as a percentage of total loans for the system is at 4.6% in March of 2015. This hasn't worsened, was the word that came in from Maitri, and which is where the cautious optimism bit was really coming from. But what is really going to ensure that this cycle change just from here on? We're not seeing credit offtake. We're not seeing the big bang projects break ground. We're not seeing the big investments kickstart. What is really going to change the life cycle? I'm going to speak about PSU recapitalization and all of that in just a bit, and I think those are important topics to be addressed. But what is going to change or dilute the toxic assets that are sitting on banks' balance sheets?
I think in short, I think an improvement in cash flows is very, very critical at this point in time for corporates. I would presume that the slippage that you're hearing from 4.6 to 4.8 over the next couple of quarters would probably be due to the slippages in the restructured assets falling into an NPA status. So that would be one cause, I mean, one of the reasons how NPA levels would increase. But going forward over a period of time, to bring back some of these stressed assets into the standard status, you would need an increase in cash flows. To a certain extent, I think some part of this would be helped by a drop in interest rates in the cost of borrowing. So I'm also fairly confident that going forward, you will see continuing transmission into lending rates of banks. We are also hopeful that the Reserve Bank has room for another 25 or a slightly larger cut. So all of these will help. But the biggest factor that will determine the level of how many of these stressed assets move back into standard form will be an increase in cash flows. Now remember that a large part of the cash flows will be coming in from the government, and we are seeing encouraging signs that the government is spending, particularly in terms of the vendors and the other contractors who work with the government. A lot of spending is coming in from quasi-government entities like Power Grid Corporation, NHAI and so on. So I think all of these will contribute to reducing the levels of stress in the system, but how quickly growth begins to improve will play a critical part.
It's important that you say that, because according to the RBI, the stress test does show that gross NPAs will increase to 4.8% by September of 2015. And they will, of course, improve to 4.7% by March of next year. Maitri, I want you to come in on that, because if you actually talk about the credit risks and the shocks that exist in the system, the report very clearly highlights the corporate's ability to repay debt has declined in fiscal year 14, and it also says sectors like mining, iron and steel, textiles, infra, aviation continue to contribute over half of the stressed loans. These are sectors that are not picking up anytime soon.
Oh, that's true, but there has been some improvement both in the core sector growth as well as in the IIP. So things like textiles, etc., would improve. As far as the core sector is concerned, there's also some sign of recovery over there. Also, one must realize that the government has taken concerted efforts to try and ease the glitches that they were in the infrastructure sector. They've junked the PPP model, they've talked about an EPC model, and even though now land acquisition does seems to be an issue, we're talking, mind you, of projects that have already been financed. So presumably land acquisition is not an issue over there. There are other issues of clearances, environmental clearances, presumably that held up these projects. So I think the government is working on the nitty-gritty, the plumbing as it were, and given the fact that the picture hasn't worsened. If you look at stressed assets, they were 10.2% in September 2013. From 10.2% in September 2013, they've inched up to a little below 11% now in 2 years' time, during a time when the economy really wasn't growing. So maybe I'm just clutching at straws, but I think that the situation is on the mend, and given the fact that the government is making concerted efforts to get the economy moving once again, I would kind of urge a little bit of caution, and ultimately the best elixir for NPAs is really growth. If growth comes back, then I think we'll be out of the woods.
And growth is the one rise that will hike all boats there. But we've got Ms. Usha Thora joining us on the phone line as well, a very, very special guest, knows exactly what's happening in the macroeconomy and, of course, on this report. Thanks very much, Ms. Thora, for being with us. I'm going to first talk to you about the picture that's being painted on the banking sector. It's raising a red alarm as far as the bad assets are concerned, and we were discussing just now what is really going to change things from here on. I first want to ask you, is the report way too hawkish as far as the NPAs are concerned, or are you hopeful that things will move on from here on?
I think the report is really a statement of facts. So as far as the banking sector is concerned, they say the deterioration in banks' asset quality will continue for a few more quarters. And that's also arising from the same point that Maithili made, because recovery in business sentiment not yet taken firm root. Until the economy recovers, the banking system cannot but reflect the economy. So I think that is the point that's being made. But it also goes on to say that capital adequacy to be above 9% even under severe stress. So overall, I would say that while we do expect higher provision, and this is not a surprise, everybody in the market has been thinking that public sector banks will have to hike the provisions for credit risk. And there are, sectors in the economy like the power sector, which is proving to be a big headache for the banks because the state electricity boards' balance sheets are also in distress.
That's a fair point indeed. In fact, the report does say that the banks may have to hike provisions for credit risks. I have a quick question to ask of you before I hand it over to Maithili to take the discussion forward. And the question really comes from the fact that the credit growth, if you were to see, hasn't really shown significant improvement despite a lot of decisions that have been taken here in New Delhi or by the central banks. So I'm going to ask you about the credit growth, and I have a very quick question also on the observation that the report makes on monsoon. It says price pressures from subnormal monsoon is a risk to inflation. That's exactly what Governor Rajan had said in his monetary policy, and many people believe it was perhaps a stance taken way too early. Rain seems to be normal this time around. Or do you believe it's good that RBI and this report also is erring on the side of caution?
Okay, to answer the first question, which is really on credit growth, I think the data clearly show that the very, a significant slowing down of credit growth in this current year. And when you look at the sector-wise distribution of credit growth, you'll find that it is the industry sector which just, grew by a very small percentage, just 5.6%. And if you exclude infrastructure, then the growth was even smaller at 3.4%. So the credit growth in the sectors which really grew was agriculture and retail credit and trade. Now, the reason for the slowing down of credit is clearly it's also the the general tone of growth in the economy itself, which means the credit demand is really not to the extent anticipated. And there's also definitely more risk aversion on the part of the banks, which really want to which have to worry about the kind of NPA. So I think there is more discrimination in granting of credit, as also the credit demand, which is also slowed down. So the second point was about what was it? What was your second point?
It looks like rains have been normal. So are we being too hawkish here?
Yes. So that price pressures from subnormal monsoon is a risk to inflation. Actually, in the sense that, giving an opinion on the monsoon so soon is not really correct, because, of course, sowing has been better than normal and everything has been so far so good. But I think, again, it's a statement of fact that one should not lose sight of the fact that there could be, if the monsoon trends change, and we have known them to change in the past, it could be a risk to inflation. But I think the positive things there is external vulnerability has reduced, and the kind of growth scenario. Of course, I haven't read the whole report, but the kind of expectation that Maitri really brought in the beginning, there have been certain measures taken, hopefully. But there are many areas where the government has to focus on this problem of the NPAs in the public sector banks. And I think that is where I think it has to be a combination of measures, starting from the governance, on which they certainly are doing something, the bankruptcy code, the recovery laws, the kind of attitude towards the promoters, and other measures which will ensure that the banking system, is able to show better resilience. And I would say, in the case of specific sectors, especially the power sector, I would say that very definitely there have to be certain supports given, and at the same time strict conditionalities imposed to see that these are actually effectively implemented. Otherwise, we'll get back into another restructuring after 3 years. So I think we should be careful not to do things which takes us back to square one, but to do things which really actually give a positive signal to those banks which are doing well.
Absolutely. Usha, you mentioned a number of reasons why banks are in the mess that they are. But if you look at the numbers, one very sharp fact that comes through is that banks lending to infrastructure almost doubled from the year 2009 to 2014. And 30% of the lending to infrastructure is now in the form of distressed assets. So can it be that banks are really not meant to do infrastructure financing? And part of the problem really lay with pushing banks into infrastructure financing, both by the government as well as the Reserve Bank of India during the years of the slowdown.
Maitri, the first part of your query is absolutely right. If you look at the data, there is a huge increase in infrastructure lending, 2009, 2010, 2011. 2011 it was at 37.8%, power was 42.4%, telecom was 57.8%, roads was 23.6%. So actually, infrastructure, the banks did, and it was very well. At that time, I don't think the banks were, to a certain extent, there could have been pressures, but the real issue was that it was realized that people were willing to pay for infrastructure. So if you got your project going and you were getting the cash flows from it, you were able to securitize it and then take on fresh exposures. So there was definitely a demand for infrastructure loans, simply because the underlying viability of the project seemed to be okay. Now, there were very many reasons why the infrastructure loans turned bad. And we know many of them were beyond the control of the bankers. But I would say there is definitely the fact remains that why are, again, the state electricity boards in the same mess as they were at that time? So we have to, and then the roads issue. So I would say that, Maitri, there is a combination. There is a certain amount of indiscriminate lending, or lending without proper, I wouldn't say without proper credit appraisal, but without the kind of milestones and releases of further wall-ups of credit, without making sure that all the people who are concerned put in the kind of efforts they should at that point of time. So it is a combination of factors, and I think it's very difficult to generalize. But the pace of credit growth was quite significant at that point of time, yes. And Maitri, for answering your other question, who else except banks will really, where are you going to get long-term funding from? You're not going to have, you don't have the...
Absolutely.
To do that. In pension funds and in insurance, how much can you get from LIC? And how much can you get, so that is a big problem for India. So maturity mismatch, while we can
absolutely.
Talk about it, the fact remains that it is the banking system.
Absolutely.
That, all these 525 things has released things a bit. But I think the kind of credit enhancements and the kind of supports that banks need, just because they're taking this maturity mismatch risk, is really something we have to look for. And even in a rehabilitation phase, which we ought to be looking at infrastructure, it has to be much more focused and very much more dealt with on a case-by-case basis, and no stop gives.
Absolutely, absolutely. Ashwin, Usha raised a very valid point that the main problem really is that if in the absence of any other kind of term lending institution which was doing the kind of infrastructure financing earlier, banks had no option and today they're left holding the can. So the question really is that do we need to fill in the gap that has been vacated by IDBI, ICICI and the other term lending institutions?
Yeah, actually do. See, I mean, we do come across this question again and again. We said, did we allow the corporate debt market really to grow in the country? We had several committees looking at discussions around that, but we still continue to rely on the banking system for both working capital as well as long debt kind of financing. And I suppose that's where the first signs of problems began. I mean, they started almost from 2008, 2009 onwards. We may have seen credit growth, but at the same time, the mismatch, the tenure mismatch was something which was sitting all the while. That was one part. And the second part is over-dependence on the banking system, really to fund the economy, could have also been one of the reasons why we are where we are at this point in time on the NPA grounds, basically.
Is that even if you address the NPA situation today, unless you look at infrastructure financing and discover an alternate means of financing infrastructure, you are going to have fresh NPAs riding on bank balance sheets. So what really is the answer? First to the stock of NPAs and then to the potential flow of NPAs. Shogato, the question is addressed to you. How does one tackle both the stock of NPAs as well as the potential flow of NPAs as long as banks continue to finance infrastructure given the risks associated with infrastructure?
Sure. Firstly, I mean, as you mentioned, that banks are probably the only set of institutions as a class which have the project appraisal skills to be able to originate infrastructure projects. We need to figure out mechanisms. We have been talking about these mechanisms for a long time. Refinancing, takeout financing and so on, to be able to hand off risk to both provident funds, LIC, insurance funds, etc., and to other sets of investors once the project is off and running. So those mechanisms need to be looked at. We need to look at credit enhancement mechanisms, credit put in place, good CDS systems, credit derivatives systems in place to be able to provide some backstops to some degree of financing. Even that is not taken off. That's something. Corporate bonds, obviously, I mean, the world over, infrastructure financing is done through corporate bonds to a very large extent. In India, unfortunately, corporate bonds in the middle segment of the ratings grade. I mean, corporate bonds are very active in India with the highly rated bonds, and probably even in the very high yield bonds which are subscribed by HNIs, high net worth individuals. But it's the middle segment which is precisely where infrastructure SPVs fall. That needs to be developed. I am hopeful that we are almost on the threshold of a fairly significant increase in corporate bond development in this middle segment. Right. And particularly if over the course of this year or maybe over the next 18 months we get in place better resolution mechanisms and a bankruptcy code, that corporate bond segment will be developed. Right. So in the meantime, the provident fund and the insurance mechanisms institutions need to play a more active role.
That's a fair point indeed. Just hold your thoughts, everybody, there, because we've got Jayant Sinha, Minister of State for Finance, speaking at an event where we are exclusive media partners, and it's time to get you the view from North Block.